In this video, we're going to go through a CFA Level 1 style question on computing the equity beta or levered beta from an unlevered or asset beta, hence the phrase relevering beta. This is part 2 of a 2-part recording on the process of first unlevering the equity beta of a comparable company and then relevering that beta to take account of the capital structure of a specific business. If you haven't watched the preceding video, please do that before you go ahead with this one. Things will make a lot more sense if you watch the 2 recordings in proper order. You'll find the relevant link in the description below. So if this is something you want to get right in the exam, do keep watching and let's get solving. So this is the question that I want you to have a go at. Sure Freight, a company operating in the road transport business, is considering a new venture in the maritime transport industry. The company has a marginal tax rate of 25% and a debt-to-equity ratio of 1.2. Sure Freight's debt is trading at a yield of 6.3%. The asset beta computed in respect of a comparable business operating solely in the maritime transport industry is 0.54. If the risk-free rate is 4.2% and the expected equity risk premium is 5.6%, the correct WACC to use in evaluating Sure Freight's venture in the maritime transport business is closest to, and we've got 7.08, 7.52 or 8.04%. Let me start by drawing the company, Sure Freight. Sure Freight has currently been operating in the road transport industry. So let me write that down as well, road transport. However, it is planning a new project in a new industry, and that's the maritime transport industry. Maritime transport. Okay. We need to compute the weighted average cost of capital which this venture will be evaluated with, and computing the WACC naturally requires things like the cost of debt. So let me write over here KD to represent the cost of that, which the scenario provides as 6.3%. That's the yield on the company's existing traded debt, as well as the cost of equity, which is also going to be required. However, this is something we're not given. This is the return required by shareholders, and we're going to need to compute this. Now, this needs to be a rate relevant to the maritime transport industry. So you can't simply use Sure Freight's existing cost of equity, seeing as until now, it operated in a completely different line of business. And over here in a different industry, shareholders should, given a different risk profile, require a different level of return. So what we need to do is use the asset or unlevered beta provided in the scenario. So I'm going to say over here, beta asset or asset beta, and I'm going to use it to compute the cost of equity. Now, this beta asset or asset beta has been computed in respect of a comparable company which operates solely in the maritime business. So the same business as the project which the company wants to undertake, maritime transport. Okay. However, as you will hopefully recall from the previous video, the asset beta, this one, is not the same as equity beta, as it assumes no debt. It's unlevered. So we must first relever the asset beta so that it properly reflects Sure Freight's capital structure. Let's recall the formula, which I already wrote down in the previous question, and that was the formula for asset beta. So beta asset equals the beta of equity times 1 over square bracket 1 minus t for the tax shield times d over e, so the debt to equity ratio, plus 1. And you don't really have to remember it off by heart. This one is pretty easy to derive, which is something I actually did in that previous video. Now, this time we are looking for the equity beta, so this term, which takes into account the level of leverage. So it is going to be higher than the pure asset beta. Let me therefore rearrange the formula so that we get an expression for beta equity. And as I said, it's going to be higher than asset beta because here we are dividing by a term to calculate asset beta. And now we'll be computing BE, which must be higher than beta of asset unless there is no debt in the capital structure of the company. So very simple rearrangement. If we want to have beta of equity on the left-hand side, that's going to equal beta of the asset, naturally, times whatever we've got here in the denominator of this fraction, so times 1 minus t times d over e plus 1 close the square bracket. Let's check the scenario for the relevant inputs. The asset beta computed in respect of the comparable business operating solely in the maritime transport industry is 0.54, and you may actually recall that this was the solution we arrived at when solving the previous question. We also have a marginal tax rate of 0.25 or 25% and a debt to equity ratio of 1.2. So plugging these numbers into the formula here, we get, I'm going to have 0.54, the asset beta, times 1 minus t, so 1 minus 0.25%, and let me just say that this is effectively 0.75 times a debt to equity ratio of 1.2 plus the 1 at the end. Let's see what we get on the calculator. 0.54 times, let me open up a bracket, 0.75 times 1.2 plus 1, close bracket. And when I click the equals key, I get a solution equal to 1.026. So basically, this is the equity beta, which has been levered up with Shawfreight's specific capital structure numbers, its debt to equity ratio. However, it was based on an asset beta computed in respect of a company operating in the maritime industry. And what we can do now is use this equity beta to compute Shawfreight's cost of equity for the purposes of actually calculating WACC for this new project. So we need to calculate the cost of equity using this equity beta. And given the data in the scenario, we've got a risk-free rate of 4.2% and an expected equity risk premium of 5.6%. What that is pointing to is that naturally we will be relying on the capital asset pricing model. So the relevant formula here to apply the CAPM is going to be cost of equity equals the risk-free rate plus beta of equity, or equity beta, the thing we just calculated, times the market risk premium, or the equity risk premium. Let's plug the numbers in, the same ones that we just mentioned or listed from the question. That's going to be a risk-free rate of 4.2%. Now, the equity beta is what we were computing over here, 1.026. This is where we need it. And the equity risk premium, as stated in the question, was 5.6%. Okay, let's see what our calculator gives as the answer. So I've got 4.2 plus 1.026 times 5.6, and this gives me a cost of equity under the capital asset pricing model of 9.95 roughly. So this is 9.95%, and we now know what to use as part of our cost of equity, 9.95. We can now move on to the computation of WACC, which is given as, and this is the classic formula you should know quite well, WACC equals the cost of equity times the weight of equity plus the cost of debt times the weight of debt, naturally times 1 minus t for the tax shield component. And we pretty much have the cost of debt to plug in over here. We've got even the cost of equity to use over here. We've got the tax rate as well, but we don't yet have the weights of equity and the weight of debt, so items pertaining to the capital structure of the business. However, there is a simple, or relatively simple way to get around this. What we do have is the debt to equity ratio for the business, and that's 1.2. And what you need to do in the exam, potentially, when not given the weights but a debt to equity ratio, is just do a bit of mathematical transformation. So the D to E ratio is 1.2. Now, let's therefore express D as a function of E. So this is going to be 1.2 times E. And what I now want to do is write the expression for the weight of debt. Weight of debt is D divided by D plus E. Now, what I'm going to do here is just a little bit of substitution. Wherever there is the term D, I'm going to use what I wrote up here. So I'm going to basically substitute this over here and over here. So this comes in at 1.2 E divided by 1.2 E plus E. So ultimately, I've got 1.2 E in the numerator and 2.2 E in the denominator. And now, if I want to do this on the calculator, it will be 1.2 divided by 2.2, because the E's cancel out, and the result I'm looking at is 0.55, and that is my weight of that. If this is the case, the weight of equity must be, there is no other way, 0.45, as the two must add up to 1. Okay, what we can now do is fill this formula with the numbers from the scenario and numbers we already calculated. So I've got cost of equity 9.95% times the weight of equity 0.45 plus the cost of debt, that was 6.3%, times the weight of debt, so 0.55. You just need to be careful not to mix these up, the weight of equity and the weight of debt. And we also need 1 minus t. Now, recall that t in this case was 25%. I used 25% down here to calculate the tax shield. It came in at 0.75, the term in the bracket, so that's 0.75. And let's see what this gives when we do the computation on the calculator. So 9.95 times 0.45 plus 6.3 times 0.55 times 0.75. Okay, I see a number, I see a result, and that is, if we round it up to 2 decimal places, 7.08%. So that should be our WACC. Let's check whether there was an answer corresponding to this in the solutions. Yes, it corresponds perfectly with answer A. So that's the solution to this rather long question.